Good evening, ladies and gentlemen. On behalf of HSBC Mutual Fund, I welcome you all to this very exclusive session on fixed income markets and some amazing opportunities which have been unveiled very recently. My name is Rajat Handa and I represent HSBC Mutual Fund. Usually we do sessions on or various asset classes. Some of you would have logged in. Last month, we had done a session on equity markets where we spoke about a certain segment of equity and the outlook on equity. And we usually see a lot of interest into anything which is related to risk-taking assets, equity. But recently, and I'm talking as early as maybe the last quarter, there has been a very strong and a revival of interest in fixed income. Now, there are many reasons to blame for this revival of interest. One of them, of course, is the fact that equity markets have been behaving in a very truant fashion. There has been a lot of volatility there. We have been experiencing volatility in equity markets since almost 8 to 9 months now. The other reasons is that because this interest has revived, because investors have been having a good experience in fixed income lately. You've seen and observed a very benevolent and a very dovish central bank in India who has been very accommodative, inducing liquidity and lowering interest rates. And there are new interesting opportunities with some tax efficiency built in, which have been introduced thanks to the regulator in India. So if I combine all these benefiting factors, I think fixed income is come back, and it's come back with a big bang. So to take this opportunity and to capitalize on this entire revival, we have a very interesting session which is on right now. To our partners who've always supported HSBC Mutual Fund, let me introduce the speaker of the day today. The speaker of the day today, and I think most of you would be knowing him, is Shriram Ramanathan. Shriram Ramanathan, let me give you a brief introduction about Shriram. Shriram Ramanathan is Chief Investment Officer, Fixed Income. He oversees the management of more than 50,000 crores in assets across various fixed income and hybrid funds. He has been with the investment management business since 2001 and has over 24 years of experience in fixed income markets. Prior to joining HSBC Mutual Fund, he was head of fixed income at L&T Mutual Fund. Prior to that, he was the portfolio manager at Fidelity Fund Management. And in his previous roles, Shriram was managing the global emerging market debt Asia at ING Investment Management Asia Pacific in Hong Kong for almost 5 years. He's also done earlier assignments with Zurich Asset Management Company in fixed income research and with the Treasury Department of ICICI Limited, where he started his career in investments way back in the year 2000. Shriram is a chartered financial analyst and holds a postgraduate diploma in business management from XLRI Jamshedpur and an engineering degree from the University of Mumbai. So welcome, Shriram, and thank you for taking out time for our partners on this call. It's very interesting and very positive outlook on fixed income. And you can see that from the smile on my face. Investors are smiling. So before we delve into the Q&A, I just want to hear some opening remarks from you on this change in outlook.
Sure. Thanks, Rajat. And hello, everyone. Thank you for logging onto the call. Like Rajat very beautifully laid out at the beginning, I think I'm fairly delighted to be having this call at the current time. I think it's fairly opportune. A couple of reasons for that. I think first is, like Rajat mentioned, fixed income markets have been doing very well. Not just now, but over the last 6-8 months, we have seen a gradual move lower in interest rates. And as that happens, all of us know, usually it leads to capital gains, and the returns of a lot of categories of fixed income funds are actually very attractive if you look over the last 1 year, 1.5 years overall. As a category, fixed income has done well. I think the second thing, which again Rajat alluded to, is the fact that I think over the last 3-4 years, asset allocations for a lot of investors on the retail HNI side have gradually got skewed a little bit more and more towards the riskier segments. I think it's a good time to take a reevaluation of one's asset allocation. And I think that's where the current fixed income backdrop really comes in as an opportune time because it helps one reassess how much fixed income should one really have as part of the core portfolio. Third, and most importantly, I think finally, we have a product on the fixed income side, which once again delivers that tax efficiency, which makes it really from a post-tax perspective extremely attractive. And that's something that we're going to talk in detail through the course of this call. But I think all three reasons put together, I think it's great to be connecting back to the retail HNI side. We have had a long break. Fixed income, we've been focusing more on the institutional segments. And I think it's a great time to be connecting with all of you. So thank you for logging in.
Thank you, Shriram. Very well articulated. I think the sun is shining on fixed income, and let's share some very interesting insights from your research and from the investment team that you head with our partners on the call today. So we'll do this in a question answer format. So I already have some questions from our partners, as we always do. We get a lot of feedback and we pose those questions to you. What I'll do is I'll read these questions. But ladies and gentlemen on the call, this does not stop you from asking your questions. As you can see, there is a Q&A tab on the screen. Please keep your questions coming in. Please keep typing your questions. Once I am finished with the questions which I have already assembled and accumulated, I will try my level best, considering the limitation of time, to pick up the questions from your Q&A tab and ask them on your behalf to Shriram. Yeah, so please do that. Also, when we end the call, just before that, there would be a feedback button on the screen. So please share your feedback with us. It always helps us to improve going forward. All right. So Shriram, the first set of questions in are on the markets. They are in general about the central bank, the central bank's actions and the outlook on fixed income. And then the second set of questions would be around this amazing and a very unique opportunity which has been unfolded and unveiled as a product for investors. So let me start with the first part. So RBI policies have been there. We've been seeing RBI policies coming in every 2 months. At times, they are a passing event. At times, there is some bit of noise. But recently, I think and if I can just allude to the policy which happened a couple of weeks ago, I think that RBI policy, the monetary policy, shed light on many positive developments and indicators on the economy. How different is the market environment in April of 2025 if you want to compare it to maybe October or November of last year?
Sure. No, I think if you really compare, and I'll just refer to this slide which lays it down fairly neatly. The things have really changed very materially as far as various asset classes are concerned, but specifically I'll focus on the fixed income part in terms of the impact on our fixed income markets. If you compare, let's say, the market environment in November 24 versus, let's say, March 25. First and most importantly, I think on the global market side, obviously November 24, we were dealing with the heightened volatility of markets with the Trump administration coming in, risks of tariffs, a lot of worries priced in. Importantly, as far as the fixed income markets are concerned, the US markets, Treasury markets were pricing in worries about inflation more than growth. And that meant that they were not really pricing in too many rate cuts from the Fed going forward. That, if you compare with the situation, let's say in March 25 or even right now, things have changed a fair bit. Growth concerns have obviously taken center stage across the world, given the various measures that are taking place in the US. And from that, within that, I think there's a lot of expectations built in that the Fed at some stage will come in to cut rates to try and be supportive to the broader economy. So that's one big change where now currently almost 2 to 3 rate cuts are priced in. In fact, more than 3 rate cuts as of today are priced in for calendar year 25 and a few more next year as well. So that's one big shift. I think the second shift importantly for us is on our domestic inflation side. October, November, we were really grappling with inflation, CPI inflation at almost 6% and higher. A lot of haziness in terms of at what pace really the food inflation demon will unwind itself. And if you fast forward now to March, we have really seen food inflation spiral down very, very quickly, much more quickly than any of us really expected, probably even what the RBI expected. And we now have a CPI at 3.3%, and really food inflation is almost come down to negligible levels. So that's a second big shift that has really happened. Growth, yes, things are fairly balanced then and now as far as we are concerned. I think the fourth important part that has changed materially, and that I think is a big relief, especially for the RBI, is the way the currency was under pressure in October to December period. And we saw that happen. The Rupee weakened, a lot of outflows happened, a lot of intervention from the RBI on both the spot and the forward side as well. And really that set up a bit of a question mark in terms of, hey, what's really happening with the rupee over here? If you fast forward now to Feb, March, clearly, I think the dust has settled. We have had the no, rupee go through a phase of adjustment, but now the rupee is a much better behaved currency. The RBI is once again recouping back its FX reserves. And overall, I think the dollar index itself has changed trajectory completely in terms of instead of at 110 and heading higher, now we really have a dollar index at below 100. And really, the worries of a runaway dollar is not really one of the base case for most of us. Importantly, we have also seen as a reaction to all these positives, we have seen a new phase of RBI. We've seen the RBI really double down on trying to make up for the liquidity which it had sucked out in the last quarter of last calendar year. And really, they have been on an overdrive in terms of pumping all of that back in. We'll take a look at it in a bit more detail later on. And finally, of course, the rate cuts, the various open market operation of RBI, etc. So all of these really contrast the situation, let's say in a November 24 versus a March 25 for us. And really, that's what sets the stage. In fact, in early March 25, we had fairly in terms of, I think, a good timing from our side. We had really changed our whole rate forecast to saying that, hey, it's no longer a shallow rate cut cycle. It's a much more deeper rate cut cycle that we expect. We were expecting almost 100 basis points of rate cuts. And really now we are seeing the market pretty much price a lot of that in. And markets are really set up now for a deeper rate cut cycle, which we had kind of forecasted somewhere in Feb, March. So I think that's a big change that we have seen as far as the backdrop is concerned, Rajat.
No, I think an excellent opening slide, Shriram. As always, your decks are extremely valuable. The ones that you present to us, very well articulated and encapsulated in this slide. So a resilient currency going into a manageable zone, and to the fact that there is a much dovish outlook globally on interest rates. So amazing. Now, there's an old song which I keep hearing, and it reminds me, it starts like, "Go west where the skies are blue." If you remember those songs from the 90s. So I can't help but going to the west and start looking at the big United States. So just taking a departure from the US outlook, let me just pick your brains on the US Fed. So US Fed has also been cutting rates, right? They also started cutting the rate cutting cycle sometime last year, Shriram. What are your views on the interest rate scenario in the US? And more importantly, as a result of that, the inflation gap between Indian and American economies?
Sure. I think, again, drawing a bit of a comparison versus autumn last year and this year's spring. I think as you would expect with those seasons, things have really opened up, at least as far as the US rates market are concerned. And we have seen the US Treasury yields really gradually drop after hitting a high of almost 4.8% at the early part of this year. We have really seen US Treasury yields, 10-year US Treasury yields go down to as low as 3.8%. Of course, now we are at about 4.3%. But the trend has been fairly stable. It's been one of Treasury yields being heading lower. The earlier worries of runaway Treasury yields, let's say Treasury yields will go to 5% and higher, which was a worry towards the end of last year, I think have now taken a back seat. It's now a wait and watch in terms of really at what point the growth weakness really starts becoming more visible in the US. And accordingly, what point really the Fed sees it as opportune to start being more supportive of the economy, of course, in the backdrop of the inflationary worries that are there from the tariff side. So if you see the chart on the right-hand side, you can see, again, contrasting between how, let's say, somewhere in December 24, the markets are broadly expecting less than 2 rate cuts in calendar 25 and almost none in the subsequent years, which meant a terminal rate of close to about 4%. Whereas if you contrast that with the red bars that you can see on that as of now, very clearly, the expected Fed fund rate, Fed funds rate by the end of calendar year 25 is about 75 basis points to 100 basis points lower than where we are right now, which means anywhere between 3 to 4 rate cuts are priced in by the markets. And over the course of the next 2 years, another 50 to 75 more. which means that overall the trajectory, and this is important for us to take home as far as our bond markets are concerned, that it's an environment where while the volatility will continue, like we have seen, there is a war of words between President Trump and Fed Chair Powell, and that volatility will continue. Nobody is denying that. But we still think that over the next 2 years, we are going to see a gradual fall as far as US Fed funds rates are concerned. And that really sets up the backdrop for us as far as our Indian bond market is also concerned. Moving to the second point that you had mentioned, and I think that's where for a lot of us in the Indian bond markets, obviously one is looking at us only domestically in terms of the growth inflation parameters, but obviously we are in a relative world. And it does matter for us what is happening with, let's say, the largest bond market in the world, the US Treasury market, and where yields are over there versus where they are over here, which is the interest rate differential between the two. And obviously, with our yields gradually coming down and US Treasury yields, let's say, coming down somewhat lower, the gap is clearly reducing. And that raises a bit of a question mark. Hey, is this gap sustainable? Is a 2% differential, interest rate differential between the two markets enough? I think over there, it's important to also, along with interest rates, look at the inflation differential.
Yeah.
And that's the huge change that has really happened, right? While the current inflation for India is at 3.3%, it's actually not too far off from where the US CPI itself is. Even if we assume a more medium-term trajectory towards the 4.2% for CPI in India, the inflation differential itself now is much lower than we have been used in the past. And that, by economic theory itself, justifies a lower interest rate differential. So I think, so while it is something to monitor, but we have to rebase ourselves, reset ourselves to the fact that it will reflect the lower inflation differentials.
Thank you, Shriram. We will take some time to come back from US and India, and maybe you can have a glass of water meanwhile. Yeah, thanks.
Yes, thank you.
Okay.
Yeah.
Okay. So now we will, I think interesting, and the previous slide, I think, showed a very different and a contrasting view from what the outlook was on the US Fed in 24 and how it changed in 25. Remarkable, right? We're looking at terminal rates of 3.3, and last year it was almost double. So very interesting outlook. Now, if you, as a fund manager, as a head of the fixed income investment team, I think three factors and three macro factors will always intrigue you. They would have always intrigued you. And those continue to generate curiosity amongst us. Economy, inflation, and currency. So let me start and break it up into two parts. In India, what's your view on these two key macros, which is typically the GDP and inflation? And the second question is, you mentioned about the interest rate differential coming down, and which also means that the rate of depreciation of the currency will also probably slow down. So your view on how the USD Indian rupee volatility has played out relative to many other currencies in the world?
Sure. I think taking your first part of the question, as far as the growth inflation trajectories are concerned, and I think as we are showing in this chart here, for us, I think it's an extremely good zone that we are in as far as inflation is concerned. Core inflation has been fairly well behaved now, as this chart shows in terms of the split of the black line as the core inflation. The worry for us really was the food inflation part. That had obviously spiked up to 10% and higher levels. That has come down virtually to negligible levels as of now, which also means now we are really looking at an overall headline inflation, which is well within the targeted 2 to 6% band that the RBI looks at. In fact, we are very much at the midpoint of that, which is a 4% target. Very important to note that in this particular, the most recently concluded monetary policy review, the governor made it a point to put it out there that the MPC believes that the inflation is durably now on target. And I think that's a big important statement from an RBI, which is usually worried about various risks to the inflation forecast, but now they really see that as fairly durably on target. And that's an important thing for us to keep in mind, that it's not just a temporary phase that we are looking at where interest rates are lower. Hopefully, if everything pans out the way we expect, we are really looking at a fairly reasonable period of time over the next year, 2 years, where inflation remains very well controlled. Moving to the GDP growth side of it, things are still evolving. I think the good part is, while there were worries in terms of our GDP growth whether there is downside risk to the GDP growth and what additional levers that we might see. I think one of the very important levers that we are seeing at play is the fact that interest rates and liquidity are being used by the central bank very, very actively to try and make sure that it provides the required tailwinds as far as growth is concerned. I think that's an important thing that we are already seeing the effects of that in both our markets and the equity markets. The other important thing is that we are in a relative world once again. The rest of the world is really grappling with growth issues which are much bigger in magnitude, obviously because many of them are more exposed to the US or more export driven, etc. Somewhere are relatively more domestic oriented, consumption oriented economy once again starts to command a premium just because it is a lot better insulated from what's happening globally. And I think that's the good part as far as we are concerned. Relatively, we start looking a little bit better compared to the rest of the world and the challenges that, especially in the coming few months and quarters that we are likely to see. And we have an inflation which is so beautifully under control that it gives the central bank enough place and ability to really try and provide the required tailwind. So I think that's the good combination as the growth inflation is concerned. Moving quickly onto the currency side, I think like I already said in the initial opening remarks itself that no, we saw a dollar index which was on a tear as far as the end of last calendar year is concerned, and we saw the dollar index move very quickly towards the 110, and projections were that it could continue going higher. We have seen an absolute about turn on that. As of today, we are at closer to 9900 in that range for the dollar index. What we are also seeing is the rupee also, after a big amount of readjustment that we saw in Q4 of last year, we are seeing a lot more stable performance by the rupee. And I think important to really look at the chart on the right hand side, because that's really the more medium term valuation parameter that a lot of us should be interested in, which is the fact that a rupee, which on real effective exchange rate terms, RER terms as we know it, it was standing closer to the 107, 108, which means it was fairly expensive towards the Q3 and Q4 of last calendar year. We have now seen that correct meaningfully. And in fact, as things stand today, we are closer to the 101. So which means that the expensiveness of the rupee has come down by almost 5 to 6% in the course of the last 2 quarters, both because the rupee itself weakened a little bit, but also because our inflation is much better behaved as well. And I think that's what gives a lot more stability as far as the dollar rupee is concerned. Going forward, yes, it will be obviously subject to the vagaries that happen globally. But I think the big phase of adjustment that we saw is kind of behind us. And which is where finally I'll just end that part with the fact that, yes, we are all worried, hey, why is the rupee so volatile? But if we really see what's happening with the rest of the world in terms of volatility of currencies, even after adjusting for the most recent volatility, as you can see on the chart on the right-hand side shows, our vols are actually way, way lower than most other emerging market and developed country currencies. And I think that's something to keep in mind. Yes, we were maybe too stable in a certain period towards the first half of last year and maybe before that. We have unshackled from that. But at the same time, while we are a little bit more volatile, that's really a lot less than what's happening with the rest of the world. So I think overall the rupee is in a much better place now. I think RBI will heave a sigh of relief on that front, and which gives them once again the ability to focus on other things that really require its attention rather than being worried about the rupee.
Absolutely. And I think that also gives a lot of comfort to international foreign investors who look at investing into Indian bonds and government securities all the time. Currency is very clearly a lead indicator, and the stability, as you summarize, is very important. Now, the other thing, Shriram, which all our partners and most of them want to ask you is about the fact that we have seen a long and a prolonged phase of foreign outflows, right? So money has been pulled out of equity markets, money has been pulled out generally. It's not been a great period of inflows if you look at the last 9 to 10 months. We have also observed that the RBI, the Reserve Bank of India, has been very, very active and very supportive. So if you can just enumerate some of the steps which you think or that RBI has taken to offset the liquidity tightness which was caused by these foreign outflows.
Right. I think for us, really over the last 3 months, that's been the one of the highlights. Coincidentally, it happened along with the change of RBI governor, wherein the new governor took over from Governor Das. And fortunately for him, the situation on the macroeconomic side also was a lot better, like we already saw.
Hmm.
But along that, what has happened is the RBI, which through the course of no, the October to December period,
Yeah.
was forced to suck out almost 4.5 lakh crores of durable liquidity from our system
Hmm.
because
Hmm.
of the various interventions that happened to stabilize the rupee, uh, has doubled down in terms of the speed at which they are pumping it back into the system.
Okay.
And it's been really heartening to see the various measures. As you can see in the slide, we started off in December itself with the CRR cut. But subsequently, the kind of moves that we have seen as far as OMO purchases and the number that you're seeing, 2.9 lakh crores, is till March 25. If you really add the subsequently the April OMOs that we're seeing right now, it's almost 4 lakh crores because we are seeing another 1.2 lakh crores getting infused into the system through RBI's open market operations as we
Yeah.
speak in this month. So overall, it's a big amount of money that they are pumping back in. Along with that, of course, they're also using instruments like the FX swaps, which is basically buy-sell swaps, which also indirectly help in terms of infusing liquidity into the system, and of course, longer-term repos. So if we go back, let's say to Jan, I don't think any of us in the market, and I'm being quite humble over here, including me, that would have expected the RBI to really
Yeah.
use this kind of a sledgehammer to pump in and the pace at which they have pumped in the liquidity into the system. And that's exactly what we have seen. And I think that's given a huge amount of comfort to the broader markets. And here I'm referring not just to fixed income, but broader asset markets, including our equity markets, that there is enough and more liquidity that's going to be made available to the system to be able to grow back, and which becomes also a good medium term GDP positive trigger as well. So overall, I think that's a huge positive. And I think we are not seeing the end of it so far. I think over the next few months, we're going to continue to see, in our expectation, further open market operations to ensure that, once again, like I said, the system is not starved of liquidity. And I think that itself is a huge tailwind for our markets.
Yeah, and as you rightly said, we've seen it in the past as well. The timely use of OMOs and combining it, you do when you cure a patient with the repo rate cuts at the right time, is the magic wand, which kind of
Absolutely.
stabilizes everything and keeps rates under control. Thank you, Shriram, for that. Now, most of our partners, or rather some of our partners and their investors, would also be maybe home loan users and mortgage. So the one question which always crops up is, when is my mortgage interest rate coming down? So Shriram, let's cut across this noise and ask you straightforward. With all these OMOs and rate cuts and the liquidity infusion happening, will this lead to a faster transmission in market interest rates?
Right. No, I think that's again, with this new governor coming in charge, I think one thing that has become very clear is that it's not just a rate cutting cycle which helps the bond traders or the mutual funds to deliver a little bit of extra pop in their returns. I think that's not the objective at all. I think the objective from the RBI side, and also I think the government obviously would also want that, is to ensure a much deeper and faster monetary transmission into the
Hmm.
economy.
Hmm.
And I think that was made clear in a number of interactions from both the government and the RBI side. And
Yeah.
which means that the proof of the eating is always in the pudding. And which really means, going back to your question, finally, I think the job of RBI is going to be seen as done, is not because the 10-year GSEC yield has suddenly come down by 30 or 40 basis points. I think what really is the final end game over here is that borrowers need to see lower interest rates, whether it's the home loan borrower, whether it's a corporate borrower out there. And this needs to be meaningful and it needs to be quick. Typically, monetary transmission does take 2 to 3 quarters. That's based on past data, that before it feeds into the system. But quite frankly, once again, the speed at which RBI is going about a lot of these measures, I think they want that transmission to happen earlier. And which is why I think over the next 3, 4 months, based on our own views of rate cuts that are likely to happen in our economy. I think coming back to your question, I think whether it's the home loan borrower, whether it's the corporate borrower, I think a lot of us on that side are going to be very happy in terms of rates coming meaningfully lower. And liquidity is going to play a very important role as far as that is concerned. The flip
Absolutely.
side of that, of course, is our depositors going to be
Hmm.
in a bit more of a difficult stop. That unfortunately is the reality of it all, because as rates trend lower, we are likely to see deposit rates come down as well. In fact, we've already seen
That's
quite a
right.
few banks lower their savings bank deposit rates and also FD rates as well. And that is likely to happen even more so going forward. The only savior, I think, over there is the fact that inflation is also now meaningfully lower. So the way to look at deposit rates always is in terms of real rates that you get over and above the inflation that one faces in their everyday lives. If inflation was 6%, obviously one expects 8% or more on the deposits. But if an
Yeah.
inflation is running close to 4%, I
Hmm.
think that's where hopefully over time depositors also reconcile themselves that, hey, in a real sense, they're still doing reasonably well. But we do see both deposit rates and lending rates come down meaningfully over the next 3 to 6 months.
Absolutely. And this is very critical and vital, like you mentioned, Shriram, for the real economy, because whatever happens in the RBI boardrooms has to ultimately translate into the real
Absolutely.
economy. And which means that inflation comes down, borrowing cost comes down, and it all has a spillover effect on the growth of the economy. We've all seen
Absolutely.
those
And
figures
and
play out
Rajat,
multiple times.
exactly. And just to lay out in terms of what we expect over the next
Hmm.
few quarters,
Hmm.
already RBI obviously has embarked on its rate cutting spree.
Yeah. Yeah.
We do expect another two rate cuts from here going forward,
Okay.
which means your policy rates come down to about 5.5%. We are
That's right.
currently at 6%. There is a small chance that maybe we might see even further rate cuts, but I think that is more subject to recessionary worries in the US really taking over and the Fed really coming in a big way in terms of cutting rates. As of now, we don't see that as a base case, which is why our base case even over here will be that policy rates are heading to 5.5%. But which also means that overnight rates go towards 5 quarter. And so there is a lot more room for interest rates to come down as far as our markets are concerned. Along with that, like I said, we have a commitment in a way from the RBI that liquidity is going to be kept
Hmm.
ample,
Hmm.
enough and more. And
Yeah.
that's the backdrop in which these rate cuts are going to be happening, which means we have to get used to the fact that we are dealing with liquidity surpluses now on a sustainable basis. And that's obviously going to impact the way yields in our market really and spreads also behave. So I think that just kind of sums up our overall macro take, which is
Yes.
why it's an overall positive outlook as far as fixed income is concerned. Expect more rate cuts, expect yields to move lower still. And really, this is may not be that temporary. I think we are looking at probably a little bit more sustained period of lower inflation and lower rates. And I think investors should accordingly not take reinvestment risk for granted at all in this kind of an environment.
Absolutely, and Shriram, I think you have crystal clarity on this entire gamut of fixed income movements and interest movements, and especially the conundrum of balancing growth with inflation. A very very interesting part. And as I had promised to all our listeners and viewers and partners on this call, that and I'll just refer to the idiom which Shriram used a couple of minutes back. He mentioned that the proof of the pudding is in its eating. So Shriram, everybody is now waiting for the pudding, and the pudding is that new and very interesting offering which has been announced recently by us and many other players in the industry. So, the distribution partners want to capitalize on some of these amazing opportunities that you spoke about. You spoke about lowering interest rates. You spoke about mark to market gains which can come in. You spoke about some of the rate cuts which can happen and the transmission, which will make deposits less attractive. So there is an exciting new opportunity, a new category for fixed income investors, and it's called income plus arbitrage fund of fund. Yeah, I'll repeat, income plus arbitrage fund of fund. It's a new category. It did not exist before March. So HSBC Mutual Fund, I believe, has, and I know has been one of the pioneers in launching this offering to our investors. Can you share from your perspective, because it comes from your house of investing, can you share the salient features of this category and how you
Right.
are positioning the HSBC income plus arbitrage active fund of fund, the way we call it?
Absolutely. No, I think, frankly, I'm quite excited that we have this kind of a
Hmm.
product now as part of our fixed income stable, not just for us, for the entire industry. I think the quick construct of this fund, which is a fund of funds, which basically means the income plus arbitrage fund of funds invests into other funds underlying. And the requirement over here in this category, which SEBI came out with as a separate category just a few months back, and of course, the budget clarified on the taxation part last year, is that arbitrage needs to be upwards of 35% in this. So minimum arbitrage allocations, which means arbitrage fund allocation needs to be at least at 35%. We have kept a range for us at HSBC at 35 to 45% as a range. And importantly, the active debt allocation part has to be the remaining 55 to 65% in our case. Specifically, as far as HSBC is concerned, two things I think I would like to leave you with. One, we are ensuring that we really focus on a very, very high credit quality portfolio,
Yeah.
which means that we are not getting into riskier credits as far as any of our funds on the underlying FOF is concerned.
Hmm.
All the funds that we have chosen over here are pure sovereign or 100% AAA. That's our choice. We have kept it like that, and we think that adds a lot more relief to investors as well, that, hey, it's a very high credit quality portfolio. So that's one thing. I think the second important feature, which I think differentiates us hopefully from a majority of the industry, is that for us, active asset allocation across various funds, and I'll just come to that in a bit more detail, is a very important premise as far as this fund management is concerned, which means that we really look to be able to add value and alpha to our investors by making sure that we invest it across the maturity spectrum in the funds that we think are going to deliver the maximum returns for our investors. Now, in all of this, the package, the good part is that we really enjoy a 2 year period if one is invested for a period of more than 2 years, and a taxation of 12.5%. Now, just to clarify, let's say typically debt funds for a lot of investors are taxed at the marginal taxation rate, right? Which typically can be as high as 39% for a lot of us. It can be maybe 25% for some other type of entities or 30%. Compared to all of that, an investment into this type of a FOF, if held for 2 years, gets a 12.5% taxation. And
Wow.
that suddenly makes it the product extremely attractive on a post-tax basis. So I think that's the important part. More specifically, I think I'll just use a couple of minutes to lay out how HSBC income plus arbitrage FOF is different from a lot of other FOFs out there.
Yeah.
Like I said, the chart that you're seeing really lays out the buckets that we have chosen. One is what we don't have a choice on, which is arbitrage fund, will be 35% minimum. Like I said, we have kept a range of 35 to 45% for investment into the arbitrage fund. The remaining part is where we have chosen three buckets. One is what we call as a defensive strategy,
Hmm.
which will, the underlying fund for that will be the ultra short duration fund, again, 100% AAA sovereign fund, wherein
Yeah.
we have kept a range of 0 to 40% allocation.
Hmm.
The core part, which is the core fixed income, is a combination of funds like banking, PSU,
Hmm.
short duration fund, and corporate bond fund, which we have kept a range of 20 to 65%. And finally, the alpha generating part. And this is very important in the current context, especially wherein allocations to dynamic bond funds and gilt funds can be between 0 to 25%. So which means that there are, in the fixed income side, there are three buckets. There is a defensive bucket, there is a core bucket, and there is an alpha generating bucket. Now, the question is, how do we really decide on which strategy suits when? I
Exactly.
think, as you can see in this slide, the right now where we belong, and I'll cut to the chase in terms of our very positive outlook on fixed income. We
Hmm.
are in the aggressive duration stand
Okay.
strategy, which is your bottommost strategy. As you can see, 35% is to arbitrage fund, 0% allocation to ultra short, because that
Hmm.
comes into play only when we are defensive, when we expect interest rates to really move higher, or capital losses to come because of our duration investments. As of now, that's not our expectation, which is why that is kept at 0. We
Hmm.
have about 40% exposure to the banking, PSU, and short duration funds, which is the core part. And importantly, we have 25% allocation to the alpha generating part, which is the gilt and dynamic. So that is where we are in the current market. Aggressive duration strategy, which means that when rates come down, We hope to be able to generate capital gains through those funds, and that really should deliver at the FOF level as well. Now, what is the other possibility? Let's say 6 months down the line, or whenever, 3 months down the line, or a year down the line, we suddenly become a bit more negative in terms of our outlook on interest rates. We expect rates to go higher. We think capital losses can result. Our job would be to try and take that call to get out of our alpha generating part, the third bucket, and move into the defensive part, which is the ultra short duration bucket. And here you're seeing a sampling of what that kind of an asset allocation will look like.
Yes.
Broadly, arbitrage can go up to 45% in that market, and ultra short duration allocation suddenly goes up from 0 to 40%. And together, these two can be 80-85% of the portfolio, and another 20% in the core part. Zero as far as duration funds are concerned. What this tries to do is that as interest rates move up and down, sorry, we really try to capitalize on the gains to the extent we can through our judgment, and we try to reduce on the capital losses when rates move up, so that over the cycle, we really try to maximize the gains. Now, the good is that this kind of flexibility wasn't available even earlier, let's say 4 years back, when debt funds used to enjoy the taxation. You had to be locked into a particular fund as an investor for 3 years or more to enjoy the taxation, which used to be 20% with indexation. Now, in a fund of funds, it really gives us as the fund manager the ability to move freely from one fund to the other fund category without any tax implication at all. It still keeps you as an investor invested in that FOF level with a 2-year horizon. But underlying, I can make as many changes as I want with the asset allocation and still have no tax implication as far as the investor is concerned. And that's what we are trying to exploit over here and really try to deliver to the customer. Quickly, I think what we use as a guide for us, because that is important for an investor, on what basis are going to be allocating. This is based on a top-down assessment that we as a team over here, which is an 11-member team that we have at HSBC, we take these monthly top-down scorings that we do. And as things stand, we are really in that aggressive duration stance, as you can see the pointer, as you can at the bottom of this green to red line. We think rates are headed lower, time to be aggressive, which is why we have that asset allocation. As this pointer gradually moves to the center or to the left, that's when we would move our allocations as well. And finally, just to round off the current portfolio, just to give you a little bit more detail. Of course, it's as of March 17, but as of today, also the portfolio allocation is pretty similar. We have 15% to the HSBC Gilt Fund, 10% to our Dynamic Bond Fund. These are typically the long duration funds, giving you enough kicker in terms of capital gains. We have the core part, which is about 35% across the banking PSU and the short duration fund. And of course, arbitrage plus cash a little bit is around the 38-39% typically. That's where. That means that we are at a duration of about 3.6 to 3.7 years. Because it's a combination of arbitrage, all these funds that you have. So it's not too heavily exposed on the long duration side, but enough to add that kicker to and deliver alpha overall to the fund. And this is just a look through in terms of the underlying asset classes. So that's a quick snapshot of where the HSBC income plus arbitrage FOF sits. I think it's a fairly differentiated product. To my mind, we are really playing out the asset allocation theme as much as we can. Really that's one of the key planks, along with the 100% AAA sovereign portfolio that we're looking at.
Thanks. Absolutely, Shriram. I think my next question was for you to summarize the benefits, but I think you've done this in this last couple of minutes. You actually summarized the key benefits. Couple of things which I just wanted to add here. I think and there are some other funds also which have been launched. But just to say and reiterate on the fact that there is a word called active in the name of HSBC fund, right? So it says HSBC Income Plus Arbitrage Active Fund of Fund. I think a lot of people tend to ignore that word, but I think that is the core differentiator, Shriram, between strategy and probably what others may want to do. So this active part, this active play of duration, the three strategies that you mentioned, right? The defensive, the core strategy, and the aggressive strategy. So in a layman's language, if I can just paraphrase what you said, right now, your positioning augurs well with your outlook on the RBI rate cuts. You just mentioned that there can be another 2 or 3 rate cuts. So you want to keep it a little more aggressive. But as and when you feel that you're reaching the end of that cycle, that's when you probably shift from the aggressive part to the
Absolutely.
core and defensive part.
Yes.
I think
Yes.
that's the active play which will probably yield that alpha which most of the fixed income investors dream of and yearn for. Amazing, amazing. Thank you so much, Shriram. I think this is a great opportunity for investors to look at. The fact sheets are available on the HSBC portals, and you have relationship managers tagged to you from asset management. Please do look at this. And Shriram, I think you have just displayed a screen here which gives some kind of a
Yes.
scenario analysis. Would you want to share a
Yes.
few seconds on that?
Absolutely. I think since given time, I'll just take half a minute on this.
Yeah.
The shaded one at the center is really the income plus arbitrage FOF. I think it's important over here to note that, of course, we have taken assumptions of a particular yield, but I think while markets will keep changing and yields might keep changing, the important thing is that the taxation over here, of course, we have taken the surcharge as well, which is why it's a 12.5% plus the surcharge taxation that you're seeing over there. Leads to a post-tax return of no, in terms of yield, if the 10%, it leads to 6%. Important thing is if you translate that back to what a typical full taxation product looks like, and if you apply that kind of a taxation, this is really equivalent to something in the 9.5 to 10% yielding product, which is an important thing. This is the way we used to think about debt mutual funds 4 years back when we had the tax advantage that was there with 3 years, 20% with indexation. That's the last column, as you can see. This particular product, even though it's an arbitrage plus debt package, it is not too different from the way debt funds used to be 4 years back when they used to have the taxation. It's a little bit more, few basis points more of taxation, but it's really fairly close. Importantly, it means that compared to products which give 7.5, 8, 8.5, 9, 9.5% kind of gross yields, suddenly you have a very high quality product, let's say an HSBC Income Plus Arbitrage FOF, which is 100% replace sovereign and the arbitrage fund, which actually is better in terms of returns as well, potentially. And also the underlying risk is way below with a daily NAV and daily liquidity that is available. So I think it changes the risk spectrum for a lot of investors who are invested in more illiquid and higher riskier asset classes. Now suddenly you have a product which is very, very high credit quality and still gives fantastic pre-tax returns if you adjust for the taxation benefit. And I think that's the real eye-opener. That's what keeps the reason for this call as well, and the excitement at our end in terms of a good product available to investors really on the fixed income side, especially dealing with asset allocation challenges at their end.
Thank you, Shriram, for this scenario as well. It can very well play out. It's one of the possible scenarios that explains the fund in a much better perspective.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.